Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
And welcome to the Global View on this Monday. Well, let's check what's going on at a macro level and longer dated US Treasury yields. They fell on Friday as the market weighed up commentary from Fed Reserve officials, which indicate a pause in the central bank's rate hike cycle. The yield on the 10-year was down to 4.25% and the 2-year up slightly at 4.97%. Fed policymakers are now in blackout ahead of their next meeting next week with this week's CPI data for August, the immediate focus for markets. Meantime, a potential US government shutdown at the end of September is another risk investors are wary of, with the potential that it could hit the economy in the months ahead. Current funding for most government programs expires on September the 30th, and if Congress is unable to pass a new budget by then, government functions would shut down. Strategists at Goldman Sachs estimate it would cut US economic growth by 0.2% for each week it lasted. Well, the US dollar a little changed and the Aussie dollar trading at, well, it looks like we're up there at 64 US cents. All right, well, let's now catch up with Rob Shears from Valor Private Wealth to talk about, well, not just about making money, but how to avoid losing money. Rob joining us now. Great to catch up with you again, Rob. All right, because, of course, we're obviously focused when, as investors, we think it's all about making money, but also you're saying it's just important to make sure you don't lose money.
Well, it's actually probably more important not to lose money, because as we know, if you lose 50%, you're going to make 100% just to get back to where you were. And the more you lose, the harder it is to get back. If you lose, 75%, you've got to increase by 4 times to get back to where you were. So it's all about not losing money, and that's Warren Buffett's 2 rules. There's rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
Yeah, indeed. Anecdotally, Rob, what have you seen? Obviously, some hard lessons that investors learn in this respect.
Yeah, it's not just anecdotally. It's actually one of my main functions for my clients is to analyse their existing portfolios and try to get them out of the huge losses that a lot of them sustain. So clients come to me as new potential clients, and they bring me a basket of 20 or 30 companies, and usually they've got BHP and CBA, and the rest of the companies there have been following trends or themes or something like that. And what I've noticed is that the biggest theme in losing money and investing is actually investing in themes.
All right, which one? So why is that then? And what sort of themes are we talking about here?
Yeah, look, well, this has been going on for centuries. There was obviously there's bubbles for centuries ago, and this is never going to finish. But the secret of not losing money is avoiding getting caught up in these bubbles and themes. So when I first started, it was trees, and all the financial advisors were selling trees and agriculture in 2007, and then obviously 2011 was the mining bubble, and the portfolios I took over of clients in 2015-16 were absolute unmitigated disasters. A lot of their stocks were down 97%. It was just horrible. I had one client who went from $500,000 to $15 million and then back down to pretty much zero, just investing in mining bubble themes. But obviously, what's the theme? I mean, there's been cannabis. There's been theme after theme: battery technology, green energy, and what on today is AI. So, but I think that there's 2 reasons why you want to avoid investing in themes. First of all, usually by the time the themes become a thing and they start building ETFs for these things, is usually the valuations are obscene, and there's too much capital. So there's this sloshing capital around these areas. But secondly, is that themes attract grift, and I'm pretty sure the fraudsters are not going for the boring and safe stocks. But if you're a fraudster, you're going after the popular themes and promising, over-promising, under-delivering, and so just by avoiding these themes, you're avoiding all the fraudsters.
Well, I mean, Rob, you mentioned one right there that is the common theme of AI, and that has really taken off this year. So from your perspective then, rather than avoiding it, how should you play it? How do you carefully analyse that rather than just sort of doing a blanket sort of coverage of potential stocks that could benefit from AI?
The problem is that you can't pick a winner when there's thousands and thousands of potential players in this space. So it's much worse than race 7, horse 7. At least race 7, horse 7, you've only got 7 horses. But when you're going into these areas and there are thousands of potential winners, picking a winner is like me hoping my head to go back. It's just irrational.
Well, on that front then, if you can't pick a winner, obviously many people opt to go for an ETF where you get that spread. Is there anything wrong with that particular strategy?
Because there's been countless number of industries. I mean, the aviation industry, my industry, has been one of the fastest growing industries over the last 100 years. There was no aviation before about 115 years ago. And it's started from nothing. It's been one of the fastest growing industries. And if you add up all the airlines' profits in that time, it's a loss. The total industry is a loss, complete loss since inception. So you can't just go in an industry, because when there are thousands of players, virtually no one makes money on average. And so, look, you might be able to find an ETF where the ETF provider is lucky enough to pick some of the good ones and they get a lucky winner. But there's more luck in that than good management. I think that if you look at the sustainable profits of industries, there's usually less than 4 or less players. If you look at paint, for example, you go down to Bunnings and you're going to go paint your house. It costs you a hell of a lot of money to paint your house these days, because there's only 4 paint companies. And that's been the same way the same paint companies from 20 or 30 years ago. And it's the same with engine makers for airlines. For airliners, there's only been 4 engine makers for airliners since the 1970s. So you're looking for slow-moving ideas, not fast-moving ideas, that are boring and safe. And that's exactly why Warren Buffett went into the 4 Japanese trading houses. There's basically 4 of those things, and it's been that way for decades. He's looking for slow-moving ideas, things which don't change, not things which change. So it's sort of everyone's doing the opposite of what they should be doing, in my opinion.
Okay, so then obviously, Rob, your portfolio there at Valor, you're talking about one that's full of boring and safe companies, I would imagine then. Give us some examples then of what you're looking to invest in or what you already have.
Yeah, so I mean, we've got a portfolio of wonderful, high quality, very high return on equity, return on capital, virtually the same number because they've got no debt, and we're looking at these companies for their dominance over decades. And the ones we're looking at the moment are Unilever, Diageo. So we've already got more Unilever. We're looking at adding Diageo to the portfolio. International Flavours and Fragrances, and Lauder. They're the 3 that we're doing work on at the moment. All 3 of them, part of the reasons why I've been quite slow on adding to the portfolio is they've all got 3 brand new CEOs, and we far prefer to invest in people who have been CEOs for a number of years. So you can see there, Estee Lauder very much out of favour. It's trading at one of the best price to sales valuations it has for many, many years. So. But this is one of the best businesses in the entire world when you look at it over the last 20 or 30 years. So we love companies which are out of favour, but we're looking for things which don't change. And the brands in these companies are going to be the same brands in 10, 20, 30 years.
All right, I think that's Diageo we got up there. Why are you liking Diageo, Rob?
So Diageo, I think I mentioned this actually last time as one of the UK stocks I mentioned last time, but Diageo is so dark spirits is a very different category to white spirits and clear spirits. It's so dark spirits, particularly they're the largest Scotch whisky exporter in the world, and it takes a very long time to build a brand. A lot of these brands were 1800 and something established, well over a century ago, and you can't just say, well, here's a new Scotch brand and we're going to sell that at a premium price. So that ability to control a lot of that market, pricing power and stability means that they'll put the price up of these Scotch whiskies over the next 20 years, and they'll sell more of them, and there's almost no scenario where that's not going to happen. So it's in terms of potentially losing money on these investments, the probability over 20 years is next to zero.
All right, well, that is the global view for this Monday. Stay with us. The Open is up just after this break.